Many times we see that loan payments aren't being recorded correctly, and this could be a video that you want to pass along to your internal staff. Um, but I think it's also good for you, the business owner, to understand what the process is, what it should look like, and how to double check that. So the most common ways that we see loan payments being recorded is that either the entire amount of the payment is being taken against the loan account on the balance sheet, or the entire amount of the payment is being expensed on the income statement. Now, we've seen other ways too, but those are the most common ways that we are seeing them. So when you are recording your loan payments, we want to see the actual principal portion of the loan hitting the loan account on the balance sheet under liabilities. And we want to see the interest portion that is being paid out to hit the interest expense account on the income statement. So let's use a vehicle, for example. So you purchase a new vehicle and you get a loan for it. You're recording the vehicle as an asset and you're taking depreciation. So every month you should be recording depreciation expense on your income statement for that asset. If you are recording the loan payment as well, you're doubling up on that expense. The interest, though, for the loan is a cost above and beyond over the cost of the asset, in this case, the cost of the vehicle. So that we do want to record on the income statement as an expense, a deductible expense. Where it can get confusing is if you are looking at your cash flow and wanting to analyze your cash needs for the next month or year or what you've been spending on cash. In that situation, when you are analyzing the cash needs of the business, you do not want to include depreciation, and you want to make sure you are including the entire loan payment for that, because that is actual cash coming out of your business. So your daily in LA is, I want you to ask your internal staff, or if you're doing it yourself, double check and see that you have the loan set up as a liability on your balance sheet, that you're recording the principal portion to that loan account, and that you're recording the interest as an expense. And one way to double check this is when you get your loan statements, and they come out differently. So sometimes, especially vehicles, if you get a statement, it's not going to break out the principal and interest, but on the next month's statement, it will show you how the previous month's payment was applied to principal and interest. So it might depend on where you're looking. But when you receive that statement that shows you the balance of the loan, you can compare that number to what is on your balance sheet under the loan account. And that is how you reconcile those loan accounts and make sure that you are recording them correctly. If there is any adjustments, typically it would all go to interest expense, unless you have late fees or they're paying for other things out of there, like certain taxes and stuff. So I hope this was helpful. It might be a little confusing at first, but if you have any questions, please let us know, and we will talk to you soon. Thanks.